Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm joined out there in the chat once again this morning by my good friend Barb Armstrong. We're glad to have Barb here, and thank you for being here with us. Barb's a 20-plus year veteran of the financial markets. She's helping out there in the chat. She's going to be there answering questions. She's got some great webcasts coming up today later on, including trading price patterns. She and I and Michael Fairborn were just on here earlier this morning talking about trader talks in today's market, kind of getting things set up and started for the day. But we're going to jump in here really quickly this morning and take a look at what's going on what seems to be, at least at the moment, to be kind of a pause day. Hump day, they call Wednesday hump day for a reason. And in this particular point, we're kind of over that hump, kind of sitting there as maybe what the markets have been doing is running into this Wednesday and maybe pausing for a little bit. So let's do this. A couple of quick housekeeping items we need to take care of, and then we'll jump in and we'll take a look at what's going on. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation. It is simply an illustrative example that includes any charts or symbols or scripts or anything else that we talk about. Those are for illustrative and educational purposes only. Remember, past performance is no guarantee of future results. Remember that equity and index options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics or risks of standardized options before considering any option strategy. Also, remember that multiple leg option strategy will involve multiple transaction costs. Spread trading generally has to be done in a margin account. Remember that anytime you're short an American style option, that short option could be assigned at any time up to expiration, regardless of where it is in the money, at the money, out of the money. When we talk about European style options, those European style options, which is generally many of the indexes and most that we will talk about in this webcast, do not allow for early assignment. So that's one of the reasons why we talk about them in this particular context. Remember, we're talking about probability analysis. We're going to talk about technical analysis, fundamental analysis. All of those ways of looking at the market are generally theoretical in nature. Nothing is a guarantee as to what's going to happen. Remember that Schwab doesn't recommend the use of technical analysis, sole means of investment research. If we talk about stops, remember that stops are not a guarantee as to where the execution price of that order occurs. And in the event of a stop limit order, there's the possibility that order could not fill at all. Also, remember, we're going to use the Thinkorswim desktop software platform. It is for educational purposes only. It is a great learning resource, specifically the paper money version of that. However, there are some things that it does not do. It does not facilitate the early assignment of short options. It doesn't allow for studies to be used in scans in the paper money version. So as you move your practice from paper to live, you understand that there are some things that may change. Now, let's jump into this discussion this morning, and I'm going to pop over here to the Thinkorswim desktop software platform. And once again, my thanks to Barb Armstrong for helping out here in the chat. My thanks to all of you for being here with us, whether you are in the live version or the recorded version of today's webcast. We're glad to have you here. Let's take a look really quickly at what's going on. And then by really quickly, I mean, we're not going to belabor this. We can see what's going on. Here's kind of that hump day pattern, right? We're pulling back, a little bit of a pullback into a support and a bounce higher. Hump day in the idea that the RSI kind of bouncing down here from the overbought line in the SPX. Take a look at the NASDAQ doing somewhat of the same thing, a little bit of a gap down and a rally. It's holding above the overbought line on the NDX index and on the Russell 2000, down a little bit. Michael Fairborn and I talked through this morning. The RSI kind of giving us a little bit of a bearish divergence and a bit of a pause here this morning. We'll talk about that specifically as we get into a couple of discussions. The other thing I wanted to look at really quick as we set the day up in indexes is what's going on with the VIX. I'm going to zoom in over here on the right-hand side. We see the VIX kind of coalescing right around this 18 handle. And the 18 handle is about the 15-year average, if you will, for the VIX. So we're kind of right around that typical area where the VIX settles. So the question is this not enough fear at the moment? Is this too much fear? We saw the big spike to the upside up into the 60 handle, and then it bled off very, very quickly. We're now back to where we were prior. And, is that an indication that there is the potential for this to move back in an upward direction? When the VIX is low, it tends to rise. When the VIX is high, it tends to fall. And what that would do, or what would drive that potentially, would be market movement. Now that we've got that kind of across the board, we kind of have that understanding of what's going on. What I want to do is I want to kind of follow along. For those of you that are brand new to this webcast, thank you for being here. We're glad that you're with us. For those of you that have been with us a while, you know that we've been following, kind of building on a particular strategy. And that idea is, if we go back to our index grid, let's grab our index grid right here. There it is, index options grid. We've been following the SPX, and what we've been doing on the SPX is selling a call spread or a put spread, depending on which direction the market is moving and depending on whether it's above or below the 200-period moving average. So selling counter trend. So when the market is above the 200-period moving average, when the SPX index is above the 200-period moving average, we're selling call spreads. We're selling put spreads. When the SPX is above, let's slow down, back up. When the market is above the 200-period moving average, we sell put spreads. When the market is below the 200-period moving average, we sell call spreads, trading against the direction of the market. Again, taking advantage of time decay, changes in implied volatility, but primarily that passage of time and capturing quick movement. What we've been doing is selling at 14 days to go until expiration, and then buying the vertical spread back at 7 days to go until expiration, and then selling another one. So here we are. If we go back a week or so, we're almost at the same level that we were a week ago. Let's go back to the monitor tab and let's take a look at this particular trade. And here it is right here. So this is our 14 days, was our 14 days to go until expiration. Now is 7 days to go until expiration. We sold the 5,700, 56.80 put spread. We sold it for $2.10. It is now currently trading for 72 cents. So it's done the majority of the work that it can do. Because it's done the majority of the work that it can do in this particular case, we're not capitalizing or not capturing a lot of additional time decay by holding on to this all the way through expiration. Even though if we were to hold on to this through expiration, we might capture another 65 cents. We're not going to be able to increase that amount that we're going to be able to bring in. And we're subject to the potential for the market to move against this spread. So the premise of this particular trade is this, for those of you that are asking the question, why do we sell at 14 days and then buy back at 7 instead of letting it go till expiration? You could let it go till expiration. That's fine. And if that's the way that you want to do this, that's fine. We're not putting a stop on this. We're not managing this at all or defending the spread. We're simply taking it as is and as it comes. So if we think about this, this is price. You've seen this curve before. And this is time to go until expiration. And this is expiration out here, right? So that's expiration. So what we're normally used to seeing, for those of you who are brand new, and this is the reason why we're doing this, what we're normally used to seeing at an at the money ATM option, and an at the money option is this type of time decay curve, right? That kind of logarithmic curve, okay? That logarithmic curve, however, when we start talking about, and let me do this. Let me grab my eraser here real quick and see if we can erase some of those. And let me grab this and we'll draw this in again. So the curve that occurs when we are kind of at the out of the money position, if we want to think about it again. So this is the OTM option, out of the money option. The curve looks somewhat like this as we get towards expiration, right? So we get the majority of our time decay coming in the first, let's say it's a 2-week option until expiration. We get the majority of the time decay in that first week prior to expiration. So the reason we're doing this in 14/7 chunks, selling at 14 days, buying back at 7, is because if this is the 7-day to expiration, this is 7 all the way till expiration, 7 days till expiration doesn't do a lot for us in terms of time decay. So as long as the market's still directionally doing what we'd expected it to do, the trade's really not gaining that much more in terms of what it can benefit us, right? But we still have the same amount of risk. So we can create this trade and kind of benefit from this. Now, the challenge is if the market makes a big move, then this option or this spread that we were selling has the risk of being threatened. And when it has the risk of being threatened, it can gain value very, very quickly, which means it could work against us pretty quickly if we get a big kind of rip your face off rally or big move to the downside, right? And so that's the challenge in this type of strategy. So we've seen that happen a couple of times in this particular case. If you go back in the webcasts, in the archives, you can see that we've been kind of run over 2 or 3 times with this spread as we've had big moves to the upside, big moves to the downside. So something to pay attention to. We'll talk through this. By the way, speaking of talking through this, I talked through the fact that Barb put out there in the chat, and our producers put out in the chat, that feedback survey. If you can do us a favor and simply click on that feedback survey, fill that out, help us out. That benefits us, it benefits you, but just know that we're grateful for you being here and for helping us out and filling out that survey. So a couple of quick questions as we get into this discussion. One is from the Great Gambler. Could we also sell the call spread instead of just selling a put spread? And the answer is yeah, that we could create an iron condor. We've done that before. Could we go further out in time? Yes, you could. Absolutely. There's nothing wrong with that. We're kind of balancing time versus the amount of premium that we receive, right? And Vic asks a great question. Historically, what percentage of these trades turn out to be profitable? That's a really good question. I mean, I think anecdotally, I don't have statistics, but anecdotally, this is a scenario where, I think we've been garnering, kind of picking up, these singles, picking up a little bit of credit each time we do it. We've been getting run over a couple of times as the market has made some big wild swings. But let's take this example and kind of go through this. A great question to ask in this discussion. So here's what we've got right now. We've got the 5,700, 5,680. So let's go back to that chart. 5,700, 5,680 put spread. And that's where we are now. You can see where the market is at the moment, and you can see where this put spread is. So theoretically, if we were to leave this alone and the market were to stay where it is, this would go out worthless. But the problem is, what if we get a big downside move? If we get a big downside move, 2 things are working against us. One, those puts are going to get really expensive simply because puts get more expensive if the market moves down. And if the market moves down, what's going to happen to implied volatility? Implied volatility is going to rise. And so that's going to work against us very quickly. If the market were to make a big move to the upside, not so much worried about that, because that puts this option or this vertical spread further out of the money. Implied volatility not as likely to rise with a big move to the upside because institutions don't typically hedge against upside performance. And it puts us into that position of saying, all right, cool, this is just even further out of the money. It's going to lose more of that extrinsic value. So let's do this. What we're going to do is we're going to come back to our monitor tab and we're going to close this down. And so I'm going to right click and we're going to create a closing order and we're going to buy this back for as little as we possibly can in this particular case, right? And we're going to just simply say, all right, buy it back. And again, this is an illustrative and educational example. We're going to buy it back. We're going to pay as much as 65 cents to buy this back in this order. And hopefully we can get a little bit cheaper than that. That's our limit price. Limit price says buy it back for 65 cents or less. Click on confirm and send, read through the order, make sure that we're okay with any alerts that are here and with the circumstances of this order. And we click on send and we fire that order off and we filled and we bought it back for 65 cents. I'm good with that because we got the majority of that $2.10 that we sold it for to begin with. All right. Now, the next thing that we're going to do is we're going to come back over here to the trade tab for SPX. And we're going to say, fine, where is our 14 days to go until expiration? And that is right here at the 4 June expiration. Okay, 14 days to go until expiration. Now we're going to go back to the chart. Now that we know what our date is, 4 June, we're going to go back to our chart. I'm going to take off this time hack that we put on the chart. We're going to remove that drawing. And I'm going to come over to this right-hand side. Now, let me just explain what we've got on this particular chart. Left-hand side is a 1-year daily chart with the 200-period moving average and the MACD histogram, which is our momentum indicator. Right-hand side of this grid is a 3-month daily chart, so still the same periodicity, right? Still the same 1 day, just a shorter aggregation period, the 3-month time frame. And we've got implied volatility. We can see that implied volatility is very low. So we're probably not going to bring in a lot of premium for selling this next vertical spread. But what that also does, when implied volatility is low, this probability of expiring cone narrows in. When implied volatility is high, that cone gets wider. And because that cone is more narrow, our strikes are going to be a little bit closer. That does two things. One, it brings in a little bit more premium, but it also imposes potentially more risk because we're closer to where the price of the stock is. And if there were a news event, because news changes everything, there's that possibility of a move up or down, right? So let's kind of put this into perspective. So here's our time hack. Let's go out. I'm going to change my drawing tool to the vertical time slice. And we're going to go to 6/4. That's right here. That's June 4th. Holy cow. That's 2 weeks away. June 4th. Crazy. And we'll just put that time hack right there. And now what we're going to do, because the price of the index, the SPX, is above the 200-period moving average, we're going to sell another put spread. Now, you notice something. Here's the put spread that we just sold and we just bought back, right, at 5,700. Implied volatility was just a little bit higher. That range was just a little bit wider, and the market was just a little bit lower. So we were a little bit lower. But here's where this is crossing. And let me do this. I'm going to expand this side really quickly. We'll maximize this cell so that we can see it. And I'm going to make this our drawing line here again. We're going to look for the crossover here. So our crossover has gone from 5,700. It's actually come in a little bit. We're going to call it 5,740. And I'm going to draw that line across right there at the 5,740 mark. 5,737, but I don't think we have a 5,737 strike. So that's where our hack is right there. That crossover, that kind of cross right there, that's where we're going to look at selling the short strike. Again, you can do whatever you want. This is simply an illustrative example. So we're going to go, we know that that's at 5,740. So we're going to go to the trade tab. We're going to come down here to the June expiration, the June 4th expiration, 14 days to go until expiration. I'm going to make these singles, and we're going to have to add a whole bunch of strikes here. So I'm going to actually go out to 100 strikes. So that's going to be 50 up and 50 down. And we're going to sell the 5,740. And you notice that's about the 17-cent delta. 17-cent delta is about where these have been falling in terms of a delta selection. Now, I'm not going to make a hard and fast rule and saying you got to beat the 17-cent delta, but that might be a consideration in terms of looking at a starting point, and also in terms of thinking about liquidity. Now, here's the thing. We've got a 10 wide spread. We could do a 15 wide spread. We could do a 20 wide spread. The one that we just did, if we go back to the monitor tab, the 5680, 5700 was a 20 wide spread. So let's kind of stick with that 20 wide scenario here. So we're going to go to the 5740, 5720. We're going to sell the 5740. We're a little closer. That's the 17-cent delta. We're going to bring in $18.90. So we'll figure about $19 we're going to bring in for that. I'm holding the control key down on my keyboard, and I'm left clicking. Now I'm going to come to the 5720. So it's a 20 wide vertical spread. And now we're bringing in $2.40, which is just about as much as the one that we had before, right? So Mindy makes a good comment here, which is the 5750 has a lot of liquidity, right? So John says, where's the spread width input? Well, I'm just selecting the strikes. I'm just looking at the strikes here, right? 5740 to 5720 is a $20 wide spread. If we wanted to do something a little bit different, you could display these as a spread. We could go up here to this layout and we could say, fine, deep and wide, 1 month, 4 strike vertical spread. And there it is right there. There's the 50. We got to come down here. 57. 40, we don't have 57. There it is, 5740, 5720 right there. There it is right there. There's our 4 strike wide, $20 wide vertical spread displayed as a spread, which is good. I'm glad you brought this up, because as we look at this, now what we can do is we can go across the line here and we can see the sensitivity of this trade. If we look at the net Greeks for this vertical spread, you can see that the net delta is 2 cents. So not very directionally sensitive at all. It's far out of the money. Net theta, okay, in this particular case is 11 cents. Not the biggest. I mean, we've got some that are bigger in this case. And that just is the variegation of these different strikes and how they're priced. This probably has a little bit less liquidity to it. And we look at our Vegas sensitivity on the 5740, 5720 vertical spread, about 23 cents of Vegas. So if implied volatility goes up, that's going to add to our premium of the net spread. If implied volatility goes down, so I don't expect that volatility is going to go down much below this 18 range. It hasn't for a while. If anything, this is going to rise, but the passage of time is going to help us out. And we're only in this for a week. So we're going to sell this spread. We created this spread. And we're going to bring that order up. 5740, 5720. $2.40 a credit, and we're going to click on confirm and send, and we're going to put this in our index options weekly group. Now, before we do this, what I want to do is I want to right click and I want to send this to the analyze tab, and we'll just take a look at this really quickly in the analyze tab and the risk profile graph. So I'm going to bring this up so that we can see this. I've got a bunch of other, let's do this. Let's go hide positions, and let's take that one out, and you can see we'll kind of have to stretch this out a little bit so that we can see it, but we can now see the risk profile for this vertical spread. We'll set the slices to break even, and you can see our break even price is way off of this screen, right, in terms of the strikes, simply because if we go to our slices, let's make sure our slices is set to break even at expiration. There it is right there. Okay, I had to just hit that again. 57.39. So as long as the price of this index stays above 57.39, well, okay, that's where our break-even point is. And we see that small gain. This isn't a home run hitter. This is a small gain picking up that $2.40 theoretically premium. And realistically, we know that we're going to close this down prior to expiration, so we know that we're not going to get $2.40 out of it. We're going to get some percentage of $2.47 out of it, but that's okay. We know that our risk is defined to the downside, right? So let's pop this trade back up. Let's click on confirm and send, read through the order again, make sure that it's going to the right place. And this is going to our index options weekly. And we're going to go ahead and we're going to send that order off and see if we get filled. And we did, $2.40. We brought in $2.40 for this spread. Okay. Now, a couple of people are asking the question, and I think this is a good question to ask. To take advantage of a foreseeable downtrend if we start to see things moving to the downside, right? And one of the things you might consider in terms of a scenario, right? And so the conditions in the question, Leon asks, what's the cheapest? What's the highest probability? What's the least risk? What's the biggest 10 bagger? I don't know. I mean, that's the question. Those are all different circumstances, right? So cheapest trade, this isn't an inexpensive trade. We look at this trade and we can say right click, confirm and send. We can see what our maximum theoretical loss is in this trade, right? It's $1,760. So it's not an inexpensive trade. That's going to be our buying power impact on this credit spread. So short vertical spread in this particular case, probably a higher probability of success, simply because the market doesn't need to do anything in this particular case. But if your expectation, if your directional bias was to the downside instead of the upside, and remember our directional bias here is to the upside, then a call spread might work, right? In selling that call spread. So thinking through that idea here. Now, we're going to do a couple of things, right? Market seems sideways as probability trader. So, in this particular case, you could, because to address Vic's question, which is the gain doesn't seem to be that high. So watch what we're going to do. I'm going to do the same thing here. Let's do the same thing. And let's kind of take this scenario here. And let's take this same trade. I'm gonna kind of come back to the same perspective and say, let's go to back to that chart and let's say, let's take the other side from a probability standpoint. Let's put a hack right there on the other side of that probability range. And hopefully this will address some of the questions here. We'll put a hack right here at the 6150 mark. So let's create an iron condor kind of bracketing this range for the market. So we'll go back out to the trade tab. We'll go out, we'll keep that 14-day time frame here, right? And we're going to do this. So if we were to just start with the put spread like we just sold, we'd come down here to the put spread. We're selling the 57.40, buying the 57.20 put spread. We're selling that one, and we're bringing in $2.40 credit. So Vic's point is, well, wait a second, that's not a lot of credit. You're right, it's not. It's not a big home run hitter. But what if we now come back over here to the call side and we say, all right, fine. We know that our strike price that we were looking at here was the 51.50 or 61.50. So let's go back over to our trade tab and let's scroll down here and let's find our 61.50 strike. And let's see if we can get, we might have to just kind of adjust this. So let's go back. Let's make this single again. We'll take that out of our spread layout there. And so let's go to the 61.50. And this is probably going to end up being kind of an unbalanced iron condor. Because if we're going to sell the 61.50, right? Sell the 61.50. And we're going to buy the 61.75, which is 25 points wide. We don't have any other increments here. So we're going to buy the 61.75. Now we've created a $4.30 credit against, if we do a confirm and send, against now a slightly higher max loss because it's unbalanced on one side. Let me show you what this is going to look like, right? Let me show you what this is going to look like. Let's go to the edit and let's right click and we'll send this to the Analyze tab. Let's take off our vertical spread that we had on before. And you can kind of see how this unbalanced iron condor is laying itself out, right? So here's our, let's go set slices to break even at expiration. There are two break-even points. So as long as the market stays between 57.35 and 61.53, we're making some money on the trade. We've increased our credit, but we've actually, in this case, because it's a little bit unbalanced, we've increased slightly our max theoretical loss, but it's not double the max theoretical loss because we know at one particular point in time, the price of the index can't be above and below our vertical spreads, right? You can only be in one place at a time. So we could sell this credit spread, this iron condor, and bring in more premium, double the premium almost, not quite double the premium, but we didn't double the potential risk in the trade. So this would be a way to do it. Now, the one thing you got to think about here, is that in this iron condor trade, you've got not 2, but 4 legs to this spread. So you've got 4 bid-ask spreads that you've got to negotiate, right, in terms of slippage. You also have higher potential transaction costs, and it makes it maybe a little bit harder to take the trade off. But and again, that's one of the considerations in this iron condor, right? So if it's a balanced iron condor, we probably are going to see that max loss stay just about the same, depending on what the widths of the strike price are. The reason it's a little bit bigger is because we have 25 points on one side and we have 20 points on the other side. So the max loss on the call vertical is just a little bit larger than the max loss on the put vertical, which means that our max loss, when we combine those, didn't go down, because oftentimes you'll see that come down in selling an iron condor, but it actually increased just a little bit. That's a great question, right? So in putting this trade on. So let's do this. Let's right click, let's confirm and send, and we're going to put this order out. I'm going to put this in a different group. I'm going to put this in my index options group just so that we can keep track of it, but it's not interfering with our 14-7 strategy. But I wanted to see how this plays out because I think that is a great question. Why couldn't you just do both? And so this is a high probability but low return type of trade, meaning the probability in this case, if both of those spreads were sold, both of those short legs were sold at a delta of about 17 cents, which is the case, and we look at the trade tab there, that means we've got about a 17% probability on either side that the market ends up above or below our short strikes. That's a pretty low probability of getting hit, which means that this has a pretty high probability of success. Not 100%. Nothing is 100%. Nothing is a no losing trade, right? And we're going to go ahead and we're going to click on send, and we're going to fire this order off and see what we get for it. There we go. We got $4.30 for it in this particular case. By the way, again, just quick reminder, there's that survey out there in the chat. Go ahead and fill out that survey. Now, let's do this. Let's kind of come back to this idea, right? And let's take a look at what's going on in the market. So at the moment, we have in our index options, I've got a Russell 2000 put option that's got 6 days to go until expiration. And we were using this particular put option as a means to hedge the performance in our portfolio. It doesn't have a lot of time value left. It's been decaying away. It's lost value. It's close to expiration. It's in fact in the money. So we could do a couple of things with this. We could salvage whatever is left by buying this back. And if we take a look at our chart and we look at the Russell 2000 RUT, the Russell 2000 is kind of moving down to the downside, but it's holding this support level. So it's kind of staying within this range. So maybe it's time, but you see what's happening to implied volatility starting to pick up a little bit here on the Russell 2000. So maybe it's time to maybe either roll this out or buy it back and then and then, or excuse me, sell it back and then buy another one, which would be the same thing as rolling, right? We're just doing it in two separate steps. So let's roll this out and down a little bit. So I'm going to extend my protection out a little bit in time, and I'm going to actually go out a few weeks here, because I know that we've got a Fed meeting out here in this time frame, right, in the first week of June, thereabouts. So I'm actually going to go out to kind of somewhere around this range, like the middle of June. And I'm not going to go this far down in terms of that one standard deviation. I'm going to kind of split the difference. So I'm going to come off of this level of support here. And I'm going to say, hey, I want to buy a put option that's going to provide some protection if the index goes below that level of support, right around that 2025, 2027 area. So what we're going to do is we're going to go back to our monitor tab, and I'm going to roll this option out. So I know by looking at the option chain here for the Russell 2000 that I want to be out here somewhere around this 13 June expiration, maybe the 20 June expiration. That's 30 days. Let's go to that 20 June expiration. Let's give ourselves a little bit of time here in this 20 June expiration. So I'm going to go to the monitor tab one more time, right click, and we're going to create a rolling order. And I know by looking at the chart, I want to be down here around that 20, we said 20, where did we say? About 2025. So let's go to the let's go to the monitor tab. We're going to right click, create that rolling order. And that means we're going to buy this back. This is going to be a debit spread, basically. We're going to create a spread to roll this long put. So we're going to say, fine, I want to buy this one back, or excuse me, sell this one back that I'm currently in, and I want to buy one that is out to the 30th of June, okay? And that particular strike is not trading. But we're not going to that particular strike for the 30th of June. We're going to go to the 2025 strike, and that one's not trading. So I wonder if we might have to go to the 2020 strike. That one is trading, or we could come back up a little bit and go to the 2030 strike, which is trading. That's going to cost us a little bit more. So this is going to be a little bit higher debit. So we're selling the one that we're currently in, and we're buying another one. And I'm going to click on confirm and send, and we're going to roll this one out. This is an example of a roll. Now, a roll is not a magic wand. A rolling order is simply a convenient way to buy back one or close down one and then open another one. In this case, we're buying back one and we're selling one and we're buying back another. And we're going to just roll this order out. It doesn't save you on commissions, transaction costs, anything else. It's simply, and it depends on the liquidity of the target strike and expiration, as you just saw. So I'm going to go ahead and we're going to click on send. We're going to fire that order off, and we rolled this out. Now, that's pretty expensive, right? Wow. Well, okay, so what could we do to offset the cost of this pretty expensive put option that we just bought? Well, if our expectation was that the market was going to continue to move generally higher, but maybe pull back a little bit, then could we also sell a call spread like we've been doing to help offset some of that potential loss? So I'm going to go to that potential cost. So I'm going to go back here to the trade tab, and I'm going to say, let's go out again. We're going to scroll down in this list. We're going to look at selling a short call vertical spread here. And I'm going to go out to about, not quite as far out as we went on the other, on the 14-7 strategy, because we're going a little bit further out in time. But I'm going to go out to about the 20 delta. And this is the 2185 call. And I'm going to look at selling the 2185 call. But as I look at this, that's got a pretty wide bid-ask spread here. So I'm going to look for a spread, and it doesn't have to even be in the same expiration. So I'm going to look for an expiration that maybe has a little bit tighter bid-ask spreads. I'm going to come here to the 13 June expiration, and I'm going to go out to about the 20 delta, because these trades are independent of one another. We're just using the proceeds from this one to help kind of offset the cost of the one that we just bought. So that's a lot better. I mean, that's 40 cents here at that 2170 strike or the 2175 strike. That's 40 cents. That's a much better bid ask spread than a buck or two, right? So I'm going to do this. I'm going to look at selling the 2175 and we're going to look at buying the 2185. I'm going to make this a $10 wide vertical spread and we're going to bring in a $1.80. Maybe we'll make that a little bit wider. So we've got the 2170 that we're going to look at selling, right? 2170 was what we were looking at selling. And we're going to buy the let's buy the 2200. Let's make it a little bit wider. So, whoops, let's do this. Let's go back and let's start this again. Selling the 2170 and let's buy the 2200. Let's make that a little bit wider. It's going to be $30 wide, right? $4.90 credit. That's at least knocking off $5 roughly off of the cost of that long put that we just put together. Now, our max loss is, in this particular case, 2150 or 2,510. So, but what has to happen is both of these legs have to be in the money, and we got to hold it till expiration. So we're going to put this trade together too. We're going to put this back in our index options group. We're going to just simply sell this short put or short call vertical against the sideways movement of the index to help offset the cost of that expensive put option that we rolled into. And it's like creating a collar, but with an index option, because we can't own the underlying index, we can't create a collar. So this is like creating a collar with a risk-defined position. So I'm going to go ahead and I'm going to sell this one, and we're going to put that order out there, and we'll see if that fills. It may take a minute for this to fill because there has been some challenges in paper money getting vertical spreads and short legs to fill in paper money. Sometimes it works, sometimes it doesn't. The Russell 2000 has been kind of hit and miss. So we'll see if that works. But nevertheless, what we're doing is if we go to our Analyze tab here and we look at the Russell 2000, let's show our positions here. We are essentially, let's take this one out of the equation. We're essentially kind of building a vertical spread, if you will. Right? There's our 30 June 2030 put, and we're kind of building that vertical spread to help manage our risk in this trade. And that's kind of the scenario that we're creating in this particular case, right? All right, so that's kind of how we're creating this order to manage this trade. We're selling the call spread to offset the more expensive put, and that's one of the ways that we can do this. So, guys, if you want to learn more about this, you want to learn more about these ideas, join us over here on the Schwab coaching page, schwab.com/coaching, and also check out the Trader Talks webcast channel. This is what I asked you to subscribe to. If you haven't done so already, click on subscribe, and then you can come over here and you can type in here short call vertical, and Barb Armstrong teaches a great series of webcasts on short vertical spreads. And then you could also do this, because what we were essentially creating was roughly the synthetic of a collar spread. You could also type in here collar, and you can see that collar spread and the collar strategy as well. So some great discussions. Now, Connie's going to be up next talking about managing an options portfolio, and then Barb's going to be up after that teaching trading and price patterns. I'll be there in the chat helping out with her. And guys, great stuff in this discussion today. Hopefully this was helpful for you. Thank you for filling out the feedback survey. Thanks to Barb for helping out in the chat. Thanks to our great production staff, Gabe, and everybody else who's reviewing this and everybody else who's out there. We appreciate that. We'll see, hopefully, some of you in our advanced options workshop coming up in Anaheim, not this weekend, but the next weekend. Have a great Memorial Day if I don't see you before then. Take care, everybody. Bye-bye.